on this beautiful Sunday morning. So again, let me just kind of update you guys. The plan today is to be, what's up, Jeffrey? Thanks for being here, bro. The plan today is to just do an interactive Q&A. I assume this is going to be 30 minutes or so, nothing like super crazy. We're kind of building some hype to get ready for a big webinar that Ben and I are going to host next month, about a month away from now. It's like second or third weekend of March. We're going to host this webinar, and on that webinar is when we're going to drop Ben's course. So Ben and I are working together to get this course built, which is basically going to be everything you need to understand, to know how to do research, to know how to formulate your own investment ideas, and then not just create the idea, but then to actually bring it to life in your portfolio. I personally have found that over the years, investment advice can get very vague, and it also can be very non-descriptive, very unclear. Oh, you want this X, Y, and Z Sharpe ratio, or you want to be in this much growth and this much income and blah, blah, blah. But no one giving very structured information, structured advice on how to formulate and educate yourself to do these ideas on your own, right? And one thing that we preach at ASFX is self-sufficiency. Becoming a consistently profitable trader was the first mission. And now with this new course, we're going to be helping the traders who are making money, like a lot of you guys here today. We're going to help you guys put that money to work. I don't want you to take these prop firm payouts and just go blow it on rented Lambos and Rolexes, okay? So as we push forward into this new course, please stay updated with me, because when we do drop it, there's going to be a pre-drop. And I would like some of you guys who have given us the time here on the webinars on ASFX TV, I'd like to get you the course first so we can get feedback from the initial people like Thomas and Luke and Ben and Otto. If you guys want the course, I'm going to have it early for you guys only, and I'm going to give you a really good discount too. So as we get closer into March, you'll be hearing more and more about that from me. We're going to do a pre-drop, then we'll do the webinar with the official drop, and there will be a really good discount for those that jump in on the early sale. Luke said, will the webinar be a Sunday again? No, it won't. We'll probably do Saturdays or Thursdays, something like that. That works a little bit better. But this weekend, I just wanted to kind of test and see how many people we could pull on God's day, on church day. So I think that's it as far as like housekeeping. Thomas and Otto, yeah, thank you guys. Good. I think you guys are really going to like this. Luke said, I will buy it now. I'm already telling you that. Good. And what we're going to do, let me just, before I bring Ben on, give you even more information, because you guys are giving me your time on a Sunday. Let me tell you everything. We're going to do two products. We're going to do the course, and we're going to do a Discord. So for those of you that are already in ASFX, we're adding a section for Ben's course where you can interact with him and ask questions and get more clarity. When you take that early bird offer that I'm going to have in a few weeks, you're actually going to get a free consultation with Ben to talk about your personal situation. We're also going to offer this second product called Ben's Inner Circle. It's basically like the Black Shirt Club, but for the longer term investing. You're going to get a monthly webinar, a monthly meeting with Ben. It's a much more like hand-holding experience throughout the year. I think we're only going to charge $2,500 for the entire year, or $250 a month to be in the inner circle. We'll probably open that up to like 10 or 15 people at first and keep it limited. But that's going to be like the upsell, if you would, because I know some of you are going to want more attention from Ben. So we are going to build a product for that as well. Yeah, Thomas said that's awesome. Yeah, it's a really good way to get like in with Ben, right? Like the course is good to build the framework and give you the information. But then if you want like, you know, the same way with the starter pack, you watch it, but then you still have questions from me. That's how you're going to get it from Ben. Okay, enough of the housekeeping stuff. You guys will hear plenty about that as we get into the next couple of weeks. Ben, if you're here, brother, let's bring you in and we will get things started. Now, before we begin, I got to give the disclaimer. Everybody say what's up to Ben. It's good to see you, Ben. Looking good.
What's going on?
Bro, your hair is always looking good. I got to wear this beanie to make sure nobody sees my son.
It's only for you, mate. You want to see it when I get up in the morning. It's all over the place.
I can only imagine, bro. Before we begin, everybody, just as a disclaimer, this is not investment advice. What we are talking about here is purely education, purely entertainment. We are not going to be giving ever specific ETFs, specific stocks. We will use historic data as examples. We will use macro news events as a framework, but we will not be giving specific advice. As you guys can understand, we don't want to put ourselves in jeopardy, but we still can provide value through, like I said, really the best word is a framework for making these decisions on your own. Is that a good way of saying it, Ben?
Yeah, I think that's the best way to look at it. Our job is to give you the skill set, teach you to fish, if you will, and then you can go out and apply that, because every single one of you is going to be slightly different, right? In terms of what your potential risk parameters are going to be in terms of your objectives and all that kind of stuff. So you have to really, our job is to give you those tools and that skill set, and then you can then build the best portfolio that suits you and your specific goals and everything like that. And we'll do everything we can on the education side to make sure that's obviously a successful journey as possible.
Well said. Well said. So everybody's saying, what's up, Ben? What's up? What's up? Hey, what's up,
We're doing,
Pranav? Good to
guys.
see you. Yeah, it's good to have everybody here. Happy Sunday, everybody. All right, so let's begin. So like I said, I want today to be super casual. It's a Sunday. It's God's day, so we don't want to be going too hard, all right? We want to get ready for a good week, but I think what we can do is kind of give everybody a little bit more information, Ben, on some of the stuff we're going to cover in the course. So I'm going to hit you with some questions. We'll kind of go rapid fire. And then for everybody listening, please feel free. I have the live chat pulled up. I will add any questions that you guys have. If we need to dive deeper, we'll add those in here too. So let's start first. First question, how to build a dividend fund that pays monthly cash. Let's talk about that like high level, Ben, because I know we have a whole section in the course that is going to be about dividend ETFs and building a dividend income fund and stuff like that. So talk to us a little bit about like specifically, if you could, like I said, high level, how to build a dividend-ish section maybe of your portfolio that pays monthly income. Do you have any thoughts on that?
Yeah, so my the way that I always try and look at dividends is they should be almost like a cherry on top of your investment portfolio, as opposed to the main core of your portfolio. So what I mean by that is there's lots of people that go out there and they chase dividend stocks or dividend-based investments, but then if it's not the best investment ever, it might be a case of the underlying investment might depreciate 10 or 15%. Yeah, you've been paid your nice 3% yield, but you're technically down 7, right? So you'd have actually been better off in an individual stock that didn't pay a dividend and had maybe gone up 5 or 6%, for example. I'm just obviously putting random numbers here, right? So the way that I always look at it is the core principle should always be applied the same, in that you're looking for a good quality investment. But if you're then looking for dividends on top, really the process should be that you're using the high quality process, but in the dividend arena. So what I mean by that is, rather than looking at the broad US market, let's just imagine it was the S&P 500 was the universe that you looked at for your stocks. Rather than looking at the whole index, you might only focus on dividend paying businesses within that index, right? But your process is still going to be the same. You still want to find good investments, i.e. a stock that, in your opinion, based on your analysis, has the chance to appreciate, because then it almost acts like a bit of a double whammy, right? Yep. You've got the investment growing. Let's say that made 8% that year, but if it also pays a 2% dividend yield, well, now you've actually got a 10% gain effectively, right?
Yep.
So I wouldn't be too obsessed with, what can I get? I haven't got a stock that pays me a dividend in April. What companies pay a dividend in April, right? So always think of it as dividends are extra on top. And, again, it has to then obviously fit the sort of profile, because it's not just individual stocks, as we're going to talk about in the course and stuff like that. There's ETFs that you could get that could kind of diversify you across a broad range of companies, and very low cost way to then get dividend exposure. You might even go down the route of bonds or whatever, and they can provide like an income. So there's various different ways of doing it. But on a top level, I would always say focus on the quality of your investment first. But if you want it to be in the dividend universe, then obviously apply it to that arena. But don't just focus on the yield, if that makes sense.
Absolutely. Do you think, and this is a side question on that, Ben, do you think that typically a fraction, like the way people look at it, and I know this is what we talk about in the course, so I'm trying not to go too deep on it, but you're really trying to come up with a personal percentage, a personal fraction that you feel comfortable putting into these dividend things. We really would never see somebody, in my experience at least, and tell me what you think, I would never see somebody with 100% of their portfolio focused on dividend paying stocks, correct? Because you just miss out on so much growth, right?
Exactly that, right? So the way that you're going to structure a portfolio will be individual, but if you do want to allocate some capital that's very focused on more of the income aspect of it, it might only be, say, 25% of your portfolio as a random number, right? But yeah, you probably wouldn't go, oh, I like the idea of dividends, so let me just put everything into dividend paying stocks and kind of see how we go, kind of thing, right?
Because like even, and what we're saying, everybody, is like some of these dividend, like you would look at, like, let's just, as an example, like AT&T is a cell phone technology company. They pay a dividend. AT&T is not going to be a stock that moves 20, 30% in a year. You're not going to get the kind of growth that I'm going to talk to the audience specifically, and people Ben's age, my age, we need to be thinking a little bit more about growth than income. And one of the things Ben's going to show us in the course, and I've seen it, so I kind of understand it already, there's a quadrant that you can kind of work your way through depending on your age and depending on your risk tolerance. And that's why what we're doing is with this course coming next month, we're teaching you how to make this decision for yourself. It's stupid for me and Ben to sit here and be like, everyone has to do this, because investing is so unique to you, your needs, your time, your perspective on money. Everything is so unique to you. We want to give you the information to do that. So like, I'll tell you personally what I think. For people that are under 40 or 50, you want to think more about growth. When you're closer to retirement, and I'm dealing with this with my mother, you want to then think about income, because you're not willing to risk as much. You want to be sure that you're going to make money and not have to work and X, Y, and Z. And that's where these different percentages can come in.
Absolutely. And just to kind of finish that point off, it's also a case of, you've always got to look at the risk that might come with it, because if you've got allocation to individual stocks, well, theoretically, on average, they're going to be more volatile than, say, something that's more diversified. So there's obviously that to come into factor. And also, depending on where you're based in the world, there could be different rules around taxes on how you pay taxes on dividends. Whereas if you had it just in an investment that was kind of appreciating and compounding, it might be more tax beneficial later down the line to deal with that more on the appreciation of the asset.
Correct.
Rather than the income along the way. So there's a couple of things you got to take into account, not just, oh, this stock pays me X.
Yeah. And I would recommend people personally figure out what tax bracket they are in so they can actually start to accurately. You don't want to be sitting here thinking you're going to get taxed at 20%. Come to find out at the end of the year, you're actually in a 37 or a 34%. You know what I'm saying? So everybody listen.
Speak to an advisor.
You got to
get a
speak
bit
to your
of an idea
advisor
before going in. And then if it does end up less, happy days.
Happy days.
but never go down and end up having to go up. Yeah.
Exactly. Okay, good. So we got another good follow-up question from Rachel here. Rachel said, what percentage of your income do you recommend investing each month? Now, this is where, Rachel, we do want to be careful because we are not making recommendations. Right? That word we have to be very careful of. We can speak on personally what we are doing. Like I would say, and I can even speak on the framework from what I was taught. If you choose to wait until you're 40 to start putting, let's just say $100 a month into VOO, which is tracking the overall market. If you wait till you're 40 versus starting when you're 30, I'm pretty sure you're missing out. We'll just approximate hundreds of thousands of dollars of gains if the market was to do what it has done in the past. So time in the market beats trying to wait till you're older and dumping a bunch of money in for the most part. I think for the most of us. Would you agree with that, Ben?
Yeah, and unless you basically get really lucky and the time that you go dumping it in, the market's crashed 40% or something like that, right?
Yes.
Yeah, 99.9% of the time, your time in the market and compounding it and building it over time is going to beat the big dump at some point, yeah.
And what I would say too, Rachel, like as someone who has made mistakes about this in the past, you don't want to get too heavy in doing this and then come to a month where your income is lower, especially if you're someone like me that doesn't get a flat salary, when your income's lower and then you're like, oh shit, do I need to pull from these investments? Because now you could be selling at a loss and incurring a taxable event. So you want to make sure you find that sweet spot where you can commit to it, even if it's $50 a month, like whatever it is that you can commit to safely and you don't worry about it. That's when I think you want to start investing. So if you can't commit any money right now, because not you specifically, Rachel, but whoever's listening, if you're in a position where you're not making enough money, that's okay. We want to get you there, right? Like that's what we do with our other course at ASFX, where we're trying to help you make more short-term money. As you start to make that money through trading and through your other businesses or whatever else, it would be, I think, smartest to start small and then slowly, as you're comfortable, add more and make it regular. Like I'm a big believer. I'll tell you a quick story. My father had been investing to one of the Vanguard funds. It could be VOO. I can't think of the ticker off the top. I have the packet right here. I could look it up. But he's up like 200 something % over the last X amount of years, like over 10 years, right? His average cost is $62 a share on VOO. That only happens due to regular investing because you get a dollar cost average. So again, it's about being regular and consistent and then just letting time do its thing. And like we've talked, I think we mentioned this in our last presentation, like Warren Buffett. Warren Buffett didn't hit the billy until he was like in his 40s or 50s. You know what I mean? It took a lot of but then once he hit the first billy, he was at 10 billion in like a year or two. Right. So time, and then it really allows things to compound. So I hope that's a good answer, Rachel, without giving a specific number. Good question from Ack. How much worse would you be if you don't do hedging in the portfolio compared to hedging in the portfolio? Like we talked about last time, Ben, with the short, how much better off, he's saying, would you be if you don't do it at all versus if you do it, or vice versa, I guess. You know what I mean? Do you follow that?
Yeah. Theoretically, and obviously there's no guarantees in markets, right? But theoretically, at least if we go off of historical returns, your best overall long-term performance from a compounded aspect is going to be if you are, generally speaking, 100% long stocks all of the time, basically, right? Because what history shows us is when you're in the markets long enough, you're not going to perfectly time tops and bottoms. You know, as you was kind of talking about there, Ross, it's about being consistent and adding to it over time, you know, all that kind of stuff. The idea of bringing in a hedge is that is if the current market that you're looking at, you deem it to be too risky based on your personal risk parameters, that the idea is that you can bring down that exposure. Now, obviously, naturally, what happens now is if the market does continue to trudge higher from there, you may still gain because you might not be, you know, you might be net long, but you're just not 100% long. But you're obviously then gaining a little bit less because your short position, for example, is losing a little bit, right? But the idea and obviously the principal point behind doing that is if now the market does drop, you don't lose as much. So there's pros and cons to it, and it really depends on kind of what the goal of the portfolio is. Like I say, if you look at based off history at least, if you were sitting there thinking, well, I just want to, at the moment, spend the next 20 years pushing maximum growth, well, you should probably not worry about any short-term dips or if the market goes down 20% or 30% or we go into a recession, because if that does happen, it's just a better opportunity for like dollar cost averaging and stuff like that we were speaking there. So if anything, you're like, hooray, perfect. But if it doesn't, well, then you're long and you just keep making money on the way up, right? So general rule of thumb, being 100% long stocks is typically going to give you the best result over time. But if you are a little bit more risk adverse or the current conditions you feel and deem to be too risky, the idea of a hedge is it does take that risk off the table to then make sure you're also nice and comfortable with the exposure you've got. So it really kind of depends on your personal goals, I guess, more than anything.
Yeah, that's a good answer. And I think if you look at it from a perspective like hey, I'm going to be doing this till I'm 65 and I want to be really good when I'm 60 or 50, whatever you want to retire at, you would think that even if you're hedged 3 to 5% of the net worth or of the portfolio, even if that loses 10%, the other 90% or so of your longs should carry and still put you up above average, hopefully, for the year, you know?
Yeah.
Cool.
Yeah, exactly that. Yeah.
Yeah. He said, great answer. Good. And Rachel said, good answer. Good. Okay. Thomas said, what percent of your total net worth are you investing into stocks and then something like a 5% high yield savings account? And then lastly, cash. So I would answer this to Thomas, and then we'll get Ben's answer. I would say you want to, of course, have cash for emergencies, right? And this depends on who you are. For example, if you're a doom and gloom prepper, you probably don't even believe in banks or stocks. And you're probably like, oh, it's all going to crash and burn. And you're never going to buy stocks. Okay, those guys probably stay broke, right? And yes, they probably have a bunker, but they're eating like military food in their bunker because they have no money to buy regular food, right? So you don't want to be that. I really don't think that's where any of us want to be. But at the same time, if you stay all cash all the time, you are not only losing money because you're not in the market, the value of the money you're sitting on is getting chopped away through inflation, through cost of goods and cost of living going up. So you have to find a balance. And I've been a big believer, and this is where I am sharing my personal thing, again, not giving a recommendation. I always have had a year of savings because I'm a self-employed person, because I'm not relying on a job to pay my bills. I need a bigger buffer. And then, of course, having a kid and having other responsibilities, you want that bigger buffer. I know many people that say 3 to 6 months of cash. That just never felt like enough for me because my income and my expenses constantly fluctuate. So this is where it is personal to you. Now, there is a definite pro right now because of where interest rates are at the time of us speaking, where you can put this money in a 5%, Marcus at Goldman Sachs high yield savings account, and you can get that money out in a day or two max. So it's really no different than cash. I personally would not see high yield savings different than cash. They're very, very, unless you're talking about cash in your hand, like hard that you put in the mattress, right? So those two are kind of the same to me because you can get that money. It's very illiquid. And then again, I know you, Thomas, you're young, so you should be thinking, I need the money in the market and invested in the market as long as possible. And again, think about what I said to Rachel. You don't want to have to sell it. That's really the idea. Is like if you put money in, the only people that, if you ask older people what they regret, I shouldn't have sold that house and I shouldn't have got out of my stocks. Because if you just hold them long enough, time tells us they do go up, right? So I think on a perspective of exact percentages, Thomas, that's where we're going to educate you guys to come up with that on your own based on your risk tolerance. But don't see the high yield savings, I think, different as cash. To me, they're very similar, because you can get it so easy. It's about being liquid. And then think about it from a sense of like, okay, I'm liquid versus what am I tied into, like a stock that then creates a taxable event when I sell it. If you put money into the high yield savings account and take it out, there's no taxable event there. So that's what I would be taxable versus non-taxable is a much different, I think, a better perspective. What do you think, Ben?
Yeah, no, I would completely agree with that. I think first things first, you've always got to make sure you've got some kind of cash pot, right? So,
Yeah.
i.e., the house that you live in, all of a sudden you discovered a leak in the roof tomorrow and it's going to cost you 10 grand, right?
Hmm.
You don't want to be able to have them sitting there going, oh shit, I haven't got any money in the bank. And as you said, it's sod's law. Those sorts of things are going to happen when the market's down. So now you're going to have to take losses if you pull it out of investments, taxable elements, all these sorts of things. So first things first, always going to make sure you've got a bit of cash. Now, how much cash you feel comfortable sitting on is obviously one of those things. It's going to be personal, right? So let's use Austin as an example. He's got a young family, things like that. He's self-employed. He couldn't afford to have a smaller cash pot as maybe someone like John Smith, who's 21, has no overhead, still lives with his parents, doesn't have kids and stuff like that. In a worst case scenario for him, it's probably not going to be as expensive as somebody with a family, right? So there's a couple of things like that that you obviously want to factor in and keep that in mind. You may set a personal rule, and this obviously isn't a recommendation. I'm just giving a random example here, where you might say, well, I always want to have 20% of my net worth. I always want to have it in cash or a cash equivalent, like Austin was saying, a high interest savings account or something like that, somewhere you can get your hands on it quick. So theoretically, for every $1,000 that you have to be able to put somewhere, £200 is always going into, or $200 is always going into a cash pot, right? Again, I'm putting random numbers here. But the point is that you're building up a buffer, like Austin said, and you've always got that safety blanket, whether it be you unfortunately lose a job or there's an unexpected, overhead, your car suddenly blows up, the engine blows up tomorrow and you need to go and buy a brand new car and you've got a big outlay there and anything like that, you never want to have to come and dig into that because as we touched on a minute ago, the most powerful element, the most powerful thing at your disposal as somebody looking at the long term is that compounding effect. And the worst thing you can do from an investing standpoint, a returns aspect, is interrupt that compounding element, right? So you always want to be able to allow that to kind of keep compounding, keep compounding. So what I would say is for you personally, probably sit down and say, right, how much cash do I need for me personally to feel comfortable based on my scenario with family, what my bills are, overheads, all that kind of stuff. Make sure that you are comfortable in the position that you're in where you've got X amount in the bank. Then as you sit there looking forward, say, right, well, out of any money that I then have to put somewhere, what percentage of that do I now want to keep topping up cash with? And what amount of that do I want to be putting into investments? Because it will do the same thing. It's building up your buffer more, right? And then also at the end of the day, you still want to live your life, right? It's not all about just saving and putting money into investments. You want to be able to enjoy things with family and friends. You want to be able to go on that holiday and do these sorts of things. So you also want to make sure you've got some cash to live your life because it's all well and good, compounding and being nice and rich and wealthy when you're 50, 60 years old. But there might be a lot of things you can't do at that age that you could have only done when you was 30, right? You're probably not going to go skiing, for example, when you're 65. So these
Exactly.
sorts of things you got to factor in. And I think at the end of the day, it's all about you being comfortable so that no matter what goes on in the world around us, because the reality is we can never tell what's going to happen politically, geopolitically, all that kind of stuff. We never know what's going to happen for sure in the economy in terms of then how it would affect assets and stuff like that. So you always want to have that buffer there. And, long term, we know that things will always go up based on history anyway. But you've also got to think that there's always going to be something to worry about. I mean, you look at the last 100 years, we know the stock market has performed unbelievably, would have compounded and made all this wealth. But over the last 100 years, we've also had two world wars, all sorts of different presidents and policies, God knows how many recessions and stuff like that. There's been a bit of everything that's happened at some point, yet the market over the long term keeps trudging higher. So we always want to have some skin in the game, have a way of compounding and building our wealth, but you've always got to have that safety blanket because if you don't, when something does inevitably go wrong or something that is unforeseeable, that could then put you in a bad way. So always make sure you've got that cash pot to protect yourself.
Great answer. Really good answer. Probably going to clip that for a Instagram reel. I got two good ones here. I'll let you take this one. How do you view insurance versus all of this investing stuff? Does that fit into this? And tell the guys, are we going to talk about that in the course? Are we going to give them info on that? Or are we kind of leaving that out?
We probably won't for the simple fact of, and it's the same reason why we don't go into the whole taxes side of things, right? Is firstly, every individual is going to be slightly different. Again, if we use the individual compared to a family, right? You're going to want to have different types of things in place and, insurances and all that kind of stuff. But also where you live, right? So easy example here. Austin's obviously based in the US. I'm based in the UK. Now, when it comes to healthcare, Austin's got to take care of himself, right? That the government aren't going to go doing anything if he needs an ambulance or something like that. God forbid, touch wood, he doesn't. But if he does, he's going to obviously need to have an insurance program in place. Otherwise, that's going to be a very expensive hospital trip. Now,
Mm-hmm.
somebody like myself, our healthcare service here in the UK, the NHS that we have here, that's funded from taxpayers' money. So I've, in theory, paid for it, but it comes out of my taxes each month, right?
Right.
So all those sorts of things you need to kind of factor in for your personal preferences. So, i.e., do I want to make sure if you've got kids, you want to make sure you've got a real good, life insurance and stuff like that. So, worst case scenario, if something happened to you, your family are looked after. All these sorts of things. So, firstly, base it on your personal preference, and then, of course, factor in where you're based in the world. So, we won't go much into it in the course because at the end of the day, it can be so varied for everybody, every single person that watches it. But definitely make sure you factor in making sure, again, it's a bit like talking about how making sure we have a cash pot, right? Making sure that you personally are
It
covered.
fits in the plan somewhere. Right.
Exactly. You can sit there and say, right, I know, in any scenario here, no matter what happens,
I can
I'm
be.
safe, right? Whether it be your car blows up or you break your leg and can't work, anything in the middle, you're protected in some way, shape, or form. And then your investments are then kind of doing their thing in the background.
It's just so different, because like some people in America, we can buy term insurance for life insurance. And some people will say, don't do that because it's a scam. And then it's like renting a house when you're dumping money into something. And if you never use it, the policy ends and you lost all that money. Other people that have benefited from term insurance would say, no, you have to have it. It's so cheap and it provides such a safety net. It's worth the risk reward.
Yep.
Everybody has a different perspective on that. So I would
Mm-hmm.
that's a definite conversation with a financial advisor or someone in the
Yes.
industry. Personally, I have term insurance and whole life insurance on myself and my wife, and we have a whole life insurance policy on my son because I believe in it. I used to sell it. It's an industry that I worked in. So I'm going to have a different perspective on it than a construction worker who's going to be like, I'm not leaving anything for my wife and kid when I die. I don't care. A lot of people act like that. I've met them.
Yeah.
I used to sit with them. They don't want to leave stuff. So again, it's their personal preference. There is no right or wrong. So
Mm-hmm.
good question. All right, last question, because I don't want to keep us too long on a Sunday, and I want to keep everybody wanting more too. You know what I mean, Ben? So we'll do this one. This is a really good one to end with. How do you make the seamless transition when managing your investments if you are used to day trading, if you're used to short-term trading? And is this something we're going to be discussing in the course? How to have the mindset to hold and what to do during the periods of time when you might want to sell? What else could you do?
Yeah, I think this is definitely where like the mentoring element will come into it, right?
Great
Because
point.
some people will make that transition seamlessly, right? And it may even be that in 6 months' time, that actually is the bulk of what they do, right? Because it just fits them personally better or whatever. Everyone's going to be slightly different. But I think this is where the mentor is, worth their weight in gold. Whether it be us or somebody else, your preference is up to you. But the point
Yeah.
being is that you've got someone that can sit there and say, right, what are you struggling with? Are you struggling with this? Or how are you making that transition? How are you setting up those accounts? Because I think one of the things that I've personally seen people do before, because they day trade as well, when they're sitting there and they're watching the market and doing the day trading, on the other screen, they've got their investment portfolio up. And you're like, you don't need to look at that. There's no reason to be looking at that. But then you're watching the numbers, then it plays with your head. And before you know it, you're sitting there thinking, oh, I should be changing this, I should be changing that. And it all gets very chaotic. So I would say try and structure it in a way that obviously suits you best. Normally, because they're longer term positions, don't sit there looking at it every day. Maybe set yourself a schedule, right? If you're someone that struggles with it, okay, I'm going to check in every Sunday. How did my portfolio perform that week? It has my company, any companies that I own got earnings next week that I need.
Can I just add
to
on that, Ben? I don't mean to cut you off, but I just would like to add it's something where you have to have conviction in your overall thesis. And that's why we are coming together to build this course for you guys, because we want to educate you. There's no specific recommendations being given. We want you to have the confidence and the education to say, I believe it's better for me to be in 0% crypto, 100% this, and you come up with that structure because you understand what you're saying. You learn the terminology, you learn the aspects of the market on the macro side and the investing side. And then you have confidence in it, conviction in it, because you're bought into it. You believe in it. So I think all of this, it's very important to see that it is educational based. And that's where, like you said, the mentorship will come in, I think, specifically, Ben, when the market turns down and people are like, okay, what do I do here? They're going to come calling for the inner circle saying, let me get with Ben and talk to him, because how do I handle this first bear market? You know what I mean? For some of them when they go through that first bear. So I think it's very, it's just like Thomas and everyone, it is just like what we talk about with the day trading, in the sense that the more you practice it, the more you know about it, the more confidence you have in it during the downturns. What do I say to everybody when they take on drawdown? do more markups, work on your rules, refine the strategy in the sense of drilling it into your head, because then it turns. It always turns. You know what I mean?
Yeah, no, absolutely, and what ties in with that is it's the whole risk management aspect, right? As we was talking about earlier on, if you know you've got cash set aside, you know that you've got your portfolio structured in a way that the level of exposure you've got at the moment, you're happy with all that kind of stuff. You don't need to look at it because you know it's taken care of. You know you've got your hedging, or you know you've got your diversification, or you know you've only got X amount invested. Where it doesn't matter if it goes up 5 or 10% or down 10%, because it's a portfolio, and like Austin said there, that you've structured based on a process that suits you and
Yeah.
your personality, your goals, etc.
You
So
can't
a
jump
lot of it
ship on it
ties in
when
with
it's
that.
go. Like, imagine this: you make 20% one year, you're down 10% the next year. You're going to jump ship on it now that you're just down one year? That's not what we want you guys to do. We want you to
Yeah.
have conviction and the knowledge to say, no, I can
Yes.
hold through this because I know this is going to happen.
Yeah.
If you don't have knowledge and education and experience, you'll freak out when those moments happen, and that's what we're going to
100%.
prevent with the course and with the inner
100%.
circle. 100%.
Absolutely. And it's the same thing with the day trading, right? If you had a down month, you suddenly want to go, this strategy broken, never going to work again. That's
No.
it. I need to go to a
I
new
mean, some
strategy.
people would, right? But then they learn
Some
after
would.
they jump around strategies enough, then they realize
Yeah.
maybe it's not the strategy, maybe it's me. Right.
Yeah, exactly that, right? But it's the same thing. But then when you get really good at that, and when you get consistent with that, and you go, okay, it's just a down week. Is there anything I can learn from it? Have I done some markups from the journal, everything, anything I could have done? Or was it just the market going, nope, this is my week to take some money from you? Because that's just the way that it works sometimes, right? You can do everything perfectly. And I think this is what makes the market so unique, right? You can be absolutely perfect and regimented, do everything you're supposed to do, and still lose money. And you get a guy that week that's all reckless and just doing whatever he wants, and he's going to make money that week. But obviously, over the next 6 months, 6 years, the guy that's regimented, the guy that has the process, the guy that manages his risk, does everything correct, will always outperform. That is just the reality of the situation. But the short-term bumps are always going to be there, and it doesn't matter whether you're day trading or investing. It's going to be the same, no matter what. It's still a strategy. It's still a market at the end of the day.
Great point. All right, friends, here's the game plan. This has been a good 30-minute Q&A to build some hype. If you have more questions, I see Thomas has some more. I know we had other ones I didn't cover. Please keep sending them to me on Discord or on email. We're going to do a big webinar in March. On that webinar, we'll answer all the questions in more detail. You're going to see a little preview of what's in the course on the webinar, and Ben's going to kind of give a really high-level overview to kickstart everybody into the course. So stay tuned for the March webinar. That's going to be huge. I have a date picked, but I'll share that when I got my graphics and all my shit ready. You guys know how it is.
It needs to be nice and fancy.
It's got to be nice, right? Exactly. But just so everybody understands, beginning of March, you'll hear from us on when the course date will be out. We will do a pre-launch. If you want to be in on the pre-launch, you're going to get a discount. You're going to get a free call with Ben for an hour to talk about your personal situation. So I highly recommend, for those of you that are here, reach out to me. Let me know you want to be in. I know Luke and Thomas, Otto, you guys want the pre-launch. We'll get that to you that week. We'll make sure you get the discount. You get the extra shit too for being one of the first people. But we're really excited, and I'm really glad to see so many of you taking this seriously and saying, okay, I'm getting the day trading stuff. I'm getting the income side of this. Now let's put this money to work. I don't want you guys to be just sitting in cash and letting inflation eat your money away. And that's why we're doing this. So I can't be more thankful to Ben for coming to us and bringing the knowledge to us. And I really, really appreciate everybody who not only has given us time here on a Sunday, but even gave us time at the last presentation. If you missed the last one, I highly recommend you go watch it. It's posted here on ASFX TV. Check that out as we get ready for everything coming up in the next month. But March is Ben's month. March, we got the course, we got the webinar. It's going to be a big blowout, a good combination, a good partnership here for ASFX. And I'm very, very excited for what's to come. So for now, we'll put a pin in it. Ben, thank you, brother. It's always good to see you.
Pleasure as always, my man.
Always. Pranav, Thomas, Luke, Otto, everybody, thank you very much for being here. Remember, tomorrow is a bank holiday, so we won't be streaming here on my New York session, but I'll be back with you guys on Wednesday. So for now, have a great weekend, everybody, and we will see you next week, and we'll see you all in March. Thanks, everybody.